Ladies and gentlemen, welcome to this SUERF Baffi Bocconi webinar on negative interest rates, effectiveness and side effects, taking stock. Over past years, several central banks around the world have lowered policy rates below zero. Also, nominal bond yields have entered negative territory, and as a result of central banks' asset purchase programs. This workshop asks, among other things, how effective has negative interest rate policy been in stimulating aggregate demand and in bringing inflation up back to target? What were the effects on banks' profitability and on the monetary transmission mechanism? What other side effects have emerged, for instance, on non-bank financial intermediaries like insurances? Are negative interest rates here to stay for the next couple of years as part of central banks' non-standard or even standard toolkit? The relevance of the topic is evidenced by the huge number of registrations that SUERF received for this event. I'm sure, however, that ultimately it's our excellent lineup of speakers which attracts so much interest. SUERF's President Jakob Haan from University of Groningen will moderate the meeting. Gaston Gelos, Assistant Director and Chief of the Monetary and Macroprudential Policies Division from the IMF, will present key findings from their new study, the key points of which have just been released as SUERF Policy Note number 235. Florian Heider, Head of Section in the Financial Research Division of the ECB, and Jesper Berg, Director General from the Danish Financial Stability Authority, will act as, I'm sure, critical discussants. With this, I hand over to Jakob.
Thank you very much, Ernest. Gaston, the floor is yours.
Well, thank you very much, Jakob. Thank you very much, Ernest. I'm honored and very pleased to be here and have the opportunity to talk about our work. So thank you very much for this kind invitation. This is a work that's joined with my colleagues Luis Brandão Marques, Marco Casiraghi, Guinness Camber, and Roland Meeks at the IMF. But as usual, these are our views. These are not the views of the IMF, its board, or its management. So the motivation is, I think, relatively clear. Ernest alluded to it already. Starting in 2012, various central banks have pushed key policy rates below zero. And this was unprecedented at the time and raised many questions about transmission and side effects. And since then, the need for monetary accommodation has become even a more topical issue with the COVID-19 crisis. And the recovery from the crisis will require sustained support, but there is limited policy space. So it is therefore particularly important to understand the scope for negative interest rate policies in the central bank's toolbox. And what we did in this paper is to take stock and assess what have we learned so far in terms of the experience with negative interest rate policies. Have these policies worked? To what extent have fears about potential side effects materialized? And we do this stock taking by looking both at the literature, but going a bit beyond the academic literature, looking at the data, country experiences, at central bank studies. And in contrast to some other surveys that have looked at broader issues of monetary policy, unconventional monetary policy, we focus specifically on aspects that relate to negative rates. So it's not about low rates more generally, but what's specific about negative rates that is different. And so let me just give a very brief background. I'm sure this is all familiar to you, but to set the stage. The backdrop to negative interest rates was the secular decline in real interest rates since the mid-80s. And the neutral rate, that is the rate that's compatible with full employment and price stability, is now close to zero, or even negative in many advanced economies. And much has been written about why that is the case. There are structural factors that are likely driving this, changing demographics, slowing productivity growth, possibly also a shift in demand towards safe assets. But the issue is, whatever the precise drivers, central banks are struggling to adapt to this reality. Because with inflation targets at around 2%, low real interest rates also mean low nominal rates, right? And this in turn implies that central banks have very little room to maneuver, at least in positive territory. So the upper chart here on this slide shows the real average interest rate in advanced economies since the mid-80s. And the lower chart shows changes in policy rates around business cycle peaks between 1990 and 2019. And these are averages for 5 advanced economies. The solid black line in the lower chart indicates that before 2009, policy rates were cut on average by between 4 and 5 percentage points when the recession hit. After the global financial crisis, there has been far less policy room, shown by the red line. And in response to the recent COVID-19 shock, the average reduction has just been 0.7 percentage points. So this lack of conventional monetary policy space means that central banks have resorted to unconventional monetary policy measures to maintain price stability. But all unconventional measures have shortcomings in addition to advantages. For example, quantitative easing seems effective in providing monetary accommodation by lowering long-term interest rates, but may also shrink banks' interest margins because the yield curve becomes flatter, and also expose central banks to interest rate risk. So, given these trade-offs, including negative rates in the mix can be beneficial, and it allows central banks to rely less on other tools, mitigating negative side effects. In small open economies, negative rates can also contribute to these exchange rate pressures, reducing the need for FX intervention. In addition, a broad policy package brings synergies that can amplify the effectiveness of each measure. For example, in principle, negative interest rate policy can reinforce forward guidance because it removes the zero lower bound constraint. It can also help steepen the yield curve, potentially helping banks in conducting maturity transformation. But as I alluded to at the introduction of negative interest rate policies, there were serious questions about the effectiveness and its potential side effects. Would there be a massive flight to cash by firms, households, and banks? Would asset prices and exchange rates respond in the desired ways? What about transmission? Would policy rates get transmitted to bank loans and deposits? For example, conceivably, banks may be unwilling or unable to pass on negative rates to depositors. Could negative rates lead to a sharp fall in bank profitability, harming instead of boosting credit? Would this mean potential financial stability consequences and market disruptions? So we took a closer look at the evidence in all these issues. Let me start with cash holding, right? If that's one of the concerns that were prevalent before the introduction of negative interest rates, and we didn't know exactly how people and how firms would behave. There is this notion of the effective lower bound, right? The rate below, there would be a move away from deposits and bonds into cash. And that effective lower bound is mainly determined by the cost of storing and holding and insuring physical cash. However, we have not seen a widespread increase in the use of cash in countries that have implemented negative interest rate policies. Even though in some countries the use of cash has grown over the last 2 decades, there is no indication that these increases were accentuated by the introduction of negative rate policies. And similar trends can be found in countries that have not adopted them. Except in the euro area, we also don't see an increase in vault cash held by banks. I'm not showing this here, but in most countries you don't see that. You see a little bit of that in the euro area. And many studies have tried to estimate what is the effective lower bound, and these effective lower bound estimates vary. They vary across country, and they vary also reflecting different assumptions about storage, transportation, and insurance costs associated with holding large amount of cash. And for example, the storage cost depends on the largest denomination banknote available in each jurisdiction. And these estimates, they have been coming down in line with the evidence. For Canada, they imply an effective lower bound between -25 and -75 basis points. And the range is somewhat similar for other countries. But again, these estimates are subject to revision as we learn more about how people actually behave during negative interest rate periods. So let me now turn to asset prices. We've seen overall a strong transmission to asset prices as policy rates went negative. The impact has been most visible in short-term money market rates, but also overall yield curves shifted downwards after negative rate announcements, showing an immediate but also persistent negative response, as we can see here in the case of Sweden. Once rates are negative, the impact of rate cuts on the yield curve appears to be similar to that of interest rate cuts in positive territory. Stock market indices kept rising after the introduction of negative rates, and the evidence on corporate bonds is more mixed. In the case of Denmark and Switzerland, there is some evidence suggesting that negative rates contributed to easing appreciation pressures. Let me say a few words about transmission to bank rates next, to lending and deposit rates.
Gaston, I'm sorry to interrupt you. There's a very nice question from David in the chat. I don't know whether you have the chat open.
No, I don't.
Okay, perhaps you can. I can also read it aloud if you like.
Yes, why not?
David asks, is the value of cash in the slides the value of currency in circulation as opposed to cash withdrawn from ATMs or over the counter at banks? I think this is a pretty easy clarifying question, so perhaps you can address it.
This is cash in circulation. Thank you. Okay, so negative rates negative rate policies lowered rates on new mortgages and corporate loans, especially floating rate loans, which are indexed to money market rates. However, there is substantial heterogeneity across banks in the effects on lending rates. And we look a little further at the heterogeneity across effects on banks in later on. Deposit rates also declined. However, for household accounts, so far, zero mostly generally appears to be the lower bound, although some commercial banks have started to charge negative rates also on retail accounts. More typically, however, banks increased fees on accounts for these retail accounts. How about mortgage and loan rates? The negative interest rates seem to have lowered rates for new mortgages and corporate loans. Bank lending rates fell in Denmark, for example, after the introduction of negative rates, even if the immediate pass-through from policy rates may have declined. Floating rate mortgage rates fell substantially in the euro area and Sweden after policy rates turned negative. And similarly, new corporate lending rates in the euro area dropped sharply after the adoption of negative interest rate policy. The pass-through from corporate lending rate to corporate lending rates from the ECB first 10 basis point cut was more than 30 basis points after 3 months. However, the cut was accompanied by the announcement of TLTROs, which clouded the picture. And this is a bit of a general theme that we see, that it's sometimes a little hard to distinguish the precise effects of negative interest rate policy from other policies. And I'll say more on that. We tried to look at whether there was a structural break in the transmission of policy rates to other rates once you enter negative territory. And we did some simple analysis, and we do not find evidence that this transmission has changed. So with this regression analysis, where we look for structural breaks, we only find 2 structural breaks in 2 episodes in Denmark and in the euro area. And among these, only the break from July 2012 to February 2013 in Denmark, that was the only one that occurred after the adoption of negative interest rate policy. So basically, we found 1 structural break after the introduction of NIRP, but not in general. Overall, there seems to be therefore no evidence that the transmission is different in negative territory. But of course, I have to add the caveat that we do not control for other things. There may be confounding factors, and other measures may have been taken at the same time. What about bank lending? We have not really seen adverse effects on bank lending. In fact, banks with more liquid assets, that is, which are more exposed to negative interest rates, increase lending more after the introduction of negative rates. But overall, the evidence on the funding structure is a bit mixed. Some studies find a stronger response by banks with higher wholesale funding, that is, banks that are in principle less hurt by negative interest rates. Other studies suggest that a higher share of deposits lead to a higher increase in bank lending. So there's some mixed evidence here. There's also evidence that banks take on more risk following the adoption of negative interest rate policies. But these risks do not seem to, at least so far, have been excessive, since they have not yet been followed by higher NPLs. Let me now turn to the effects on bank profitability, and I'm showing you a chart here just because the effects are a bit complex. And this is a simplified summary of the channels by which negative rates can affect bank profitability. If bank reserves pay a negative nominal interest rate, then bank income will decline if banks cannot pass on the cost fully to depositors. Banks will also earn less on their liquid assets, right, like reserves and short-term paper. But there are also positive effects. On the other hand, negative rates may support banks' net worth by boosting asset values, the asset side. More, importantly, if negative rates succeed in boosting economic activity, this means improved loan quality and a reduced need provisions. And so the question is, what's the net effect, right? And if banks' net worth is harmed by negative rates, cuts in rates, in policy rates, may produce less, not more lending, right? And so far, again, the evidence suggests that that has not been the case, that we have seen an increase in lending. But let me say a few more words about this. Overall, bank profits have been relatively resilient. So if you look at the academic literature finds that trying to control for different factors, bank profits have remained resilient. Why? Because banks did increase lending, because lower rates did stimulate demand for loans by firms and households. And this lending growth, together with gains in fees and other non-interest rate incomes, and lower loss provisions, as well as capital gains, have all helped. Nevertheless, smaller and more specialized banks seem to have been adversely affected. There's also some evidence that bank stock prices have suffered, especially for banks that rely more on deposit funding. And this finding suggests that markets expect negative rates to harm profitability in the future. Given this evidence of some different effects for different banks, it is likely that tiering regimes, whereby interest rates only become negative when a bank holds large amounts of reserve balances, can help mitigate the potential adverse effects from NIRP on small banks. How about non-bank financial intermediaries? Well, so far, there are very few academic papers or policy studies that examine the effect of negative rates on this type of institutions. And I think that that's a gap in the literature. Money market funds, for example, in principle, face a particular exposure to negative rates because they hold mostly short-term assets whose returns are closely linked to the policy rate. However, so far the evidence available suggests that the performance of euro area money market funds has held up well. Pension funds and insurers in some areas have sought to hold internationally more diversified portfolios following the introduction of NIRP. But ultimately, we are really interested not in specific banks or specific sectors, but in the economy as a whole, right? Has the negative interest rate policy supported the goals of the central bank in boosting inflation and output? And here the evidence is still scarce. And partly that's because the policy is relatively new and it's hard to disentangle. It's even harder to disentangle these effects at the aggregate level, right? Because again, one reason is that negative rates have almost always been accompanied by other measures. So if you look at aggregate data, it's very difficult to understand, to distill the precise effect of negative rate. Nevertheless, judging by the effects of long-term interest rates, we would expect that the effects on inflation and output have been similar, or at least as large as those estimated for conventional monetary policy. And there is also some model-based analysis that supports this view. But again, evidence suggests that it has worked similarly to other policies, but we still lack more research to understand this better would be useful. Just a few words about implementation. One implementation issue, namely tiering regimes. I alluded to this earlier. I don't want to dwell too much on it. but several central banks have introduced a tiering reserve regime to mitigate the impact of negative rate policies on bank profitability. And the idea is to remunerate a share of reserves at a higher rate than the marginal policy rate. And central banks have used different variants of such schemes, and that depends to some extent on the characteristics of their banking systems. For example, the exemption is sometimes proportional to reserve requirement. In Japan, they have a three-tier system with 3 different categories of reserves and 3 different remuneration. Overall, the experience with tiering regimes seems to have been positive so far. Negative interest rates, however, do pose communication challenges, and central banks have followed different approaches in discussing negative rates. But I think we can distill a few lessons at this point. First, central banks should clearly explain the expected benefits of adopting negative interest rate policies and the likelihood and size of potential side effects of negative rate. Particularly since this is so new, a lot of explanation is really required. Second, central banks need to stress that they will continuously monitor potential side effects and act to alleviate them with adequate instruments. For example, tiering regime. Third, communication should highlight the difference between nominal and real interest rates, emphasizing the prominence of real rates in affecting macroeconomic conditions and also household budgets. Right? Finally, central banks have not adopted negative rates yet should not rule it out, because maintaining the ambiguity about possibly introducing it can be helpful. It can be helpful in supporting forward guidance by eliminating that zero floor on future interest rates. So let me conclude. Overall, the effects so far seem benign. There has been transmission to asset prices and interest rates, and from what we can tell, also to inflation and output. Overall, the net benefits of negative interest rate policies likely depend to some extent on the specific structure of a country's financial system. There may be some room for central banks to cut rates further, even though there is still considerable uncertainty about how low negative rates can go before adverse effects become apparent. And looking forward, if we think about research, several areas merit attention. As mentioned, we have seen very little research on non-bank financial intermediation so far. And we don't fully understand either how competition in the financial system shapes transmission in the presence of negative rates. And lastly, also, we need to understand the cross-border implications better than we do now. Thank you very much.
Thank you very much, Gaston, for your excellent presentation. Before I hand over, there are 1 or 2 issues that I would like to say a few words about. The first one is that I strongly agree with you that further research is needed for non-bank financial institutions. Coming from the Netherlands with a huge pension fund sector, we experience the daily consequences of low or negative interest rates because they create huge troubles for many pension funds. And as a consequence, there's a risk that pension benefits will be cut. In fact, they have been cut on some occasions. And of course, that will have not only consequences for those participants involved, but also for the macroeconomy as a whole. So these low or negative interest rates backfire in the case of the Netherlands seriously, also in terms of their economic consequences. So that's a serious issue. The second thing I wanted to make, I would like to comment on, based on your introduction, is the role of competition within the IBRN, the International Banking Research Network. There's a paper in the making where we examine the impact of low interest rates on bank net interest rate margins for a large set of countries, taking into account competition, especially in the deposit market. And there's indeed a difference. If there's a strong concentration, we find different effects compared to where there is no strong concentration. So yes, this competition dimension, I think, really matters. I'm very happy that we have two excellent discussions. So we start with Florian, please.
Thanks a lot for inviting me to be part of this really fascinating e-lecture. I'm basically following up from Gaston only in one particular respect, which is I'm going to be zooming in on banks, because banks, at least from the perspective of my employer, the European Central Banks, we're in Europe, in the Eurozone, and banks still are sort of the center stage of the economy. Most of the funding still goes through banks. But I have to say, I totally sympathize with this notion of looking more at non-banks as they're becoming more and more important. For example, a lot of the growth of intermediation since the great financial crisis has come from the non-bank sector. So definitely for that. So here, I would like to focus on banks and negative rates. And I'm doing so from the perspective of the research that I've been doing with some of my co-authors, and also my reading of the academic literature. So I'm gonna zoom in a little bit on the papers and the evidence there. And in doing so, this is this is my own view. Has very little to do with my employer, who may or may not have slightly different views of how effective negative rates are or are not. But for anyone interested on the official view, our board member responsible for research, Isabel Schnabel, has done a very nice talk a few months ago about the ECB's experience of going negative. So anyone interested in finding out more should go there. It's on our website. Okay. Just setting the stage yet again. What we see here are a policy rate of many central banks. There are two notable exceptions, the Bank of England and the US, because they haven't set negative rates. But a lot of other ones have gone negative around this period here. So sort of in around 2015, coming out of the great financial crisis here, and then, the sovereign debt crisis maybe, we are now in a territory where policy rates, the relevant policy rates, are negative. And I will also zoom in a little bit more. Use the research that I've been done focuses on the ECB, so it focuses particularly when the ECB went negative for the first time. But it's been 6-7 years. But I think it's important, just as a little aside, and that that sort of I think should factor in calls for setting higher rates, is that these low negative rates don't exist in a vacuum. They're part of what people have noticed, which is that rates have come down basically a lot since the late 1980s. So this is evidence from a paper by Oscar Jorda, the rate on return on everything in the QJE. And so you see here the rate on short-term and the rate on long-term bonds, and you see that both have been declining. And I'm not going to go in here, but of course we're worried about this here. We're worried about this, but if you see, there's maybe having these low rates is not that unusual. What is unusual, though, is the big gap here between the short and the longer run. So there's still a big term premium that has developed. I'm not going to talk about it, but it's just for food of thought that we may live in usual or unusual times depending on your perspective. Okay, back to the euro area. So all I'm going to say is based on evidence from the euro area. So why, what's special about negative policy rates? And I'm going to stick my head out there, and I'm going to say that what's special really about these negative policy rates is that there's a hard zero lower bound on retail deposit rates. And the first way to look at this, you can see it from here. So here we have zero, and then we have the policy rate here in light gray. So that's the up to the financial crisis. Then there's the lowering, And then basically the ECB went negative here and has gone negative 3 more times since then. And then there's 2 other rates here in this graph. There's sort of a euro area average deposit rate, the dashed line, and there is a short-term interbank rate, the 3-month Euribor. And you see that prior to the recent experience, these rates track the policy rates rather well. I mean, there's a bit of sluggishness, but they follow the policy rate. Except since we go negative, the market rate has followed into negative territory, versus now the deposit rate has leveled off at 0. And it's this wedge that creates heterogeneity in the banking system, depending on whether you fund yourself mostly with deposits or not with deposits, because that funding model is very hard to change at short notice, and it seems to be actually quite stable. So let me zoom into this, and Gaston has showed some evidence. I'm using microdata from the euro area that can sort of make this point a little bit clearer. So on the left-hand side, we have household deposits. On the right-hand side, we have corporate deposits, and I'm looking at overnight rates because I'm stacking the evidence against me, because the overnight rates are already going to be the lowest that a bank is offering, so not like this 3-year savings or something. And what you see here is again the policy rate going down, and then there's this space. So it's not just that the average rate in red or the median rate here in dark brown, they kind of level off at 0. No, the whole distribution is truncated. So these are percentiles, the 25th to the 75th, and then actually the 25th to the 5th. So these are really outliers here. And you see that there's the compression, but there's nothing happening below 0. It's just truncation, pure on household overnight deposit rates. There's a lot of empty stuff here. And for corporates, yes, there's a little bit going on, and I've exploited that. But in the big scheme of things, we just have a few outliers that are charging negative deposit rates. And if you dig deeper, then you'll find that this is mostly in the Netherlands, actually, because the Netherlands is actually the place where a lot of corporates issue bonds. And so there seems to be a relation there. But there's really, this zero low bond is pretty hard in the euro area. One can make the point differently. Here I'm just plotting the volume of deposits. Now I'm again looking just at household overnight, at overnight deposits for households and corporates. So you see that right now we have about 4 trillion of household overnight deposits and 2 trillion of corporate deposits, so 6 trillion in total. And then I'm having in dark if the rate is 0 or positive, and I'm labeling at negative if it even carries an epsilon negative rate. So we're not even talking the -40 or -50 as the policy rate. And what we see is that there is literally no overnight household deposit rate that sort of carries a negative rate. There are, of course, some. They're above 100,000. But they're tiny. They're not. If I was to zoom in, there's a little bit of gray here. There's a little bit of gray, but this is tiny. This has no macroeconomic relevance. And for the corporate deposits, yes, there is a little bit. There's about a third of them. So overall, about 85% of all deposits do not carry a negative rate. And this is still now. We're not talking, around the time that was happening. This is 6 or 7 years later in the euro area. So this was also alluded a little bit. What I'm doing here is I'm just doing 2 portfolios of banks. I'm taking the banks that have a lot of deposits and some banks that have very little deposit funding. And I'm just comparing the stock prices. So no fancy econometrics, just simple plotting of stock prices. And while you see that prior to the setting of the negative rates here, which is this line here, this is surprisingly similar evolution of the stock price, even though these could be very different banks. And as soon as you set negative rates, there is a wedge showing up here. There's about a valuation difference of about 10%. And if you want to do this well, with all the bells and whistles, then you look at Miguel Ampudio and Skander van den Heuvel's paper, but this conveys the message. The market thinks that in a negative rate environment, having your funding mostly in deposits is bad. Why? Because you just cannot pass on the cost of funding by setting lower negative rates on deposits, but you can on wholesale market-based funding. And that's something that seems to show up over and over again. There's other channels, I'm going to come to that, but that seems to be, at least in the data, pretty striking. So what I'm doing here is, again, no fancy econometrics, and this comes all from a paper that I published 2 years ago. So let's just look at the loan volume. I'm not even holding loan demand constant or anything. And again, looking before and after, and there's 3 groups of banks. They're the ones that have high deposits. They're the ones that have middle deposits funding, and then there's the one with low. And the first point to note is that, yes, the negative rates did stimulate the economy. That's not the issue. It's uncontroversial. There was the negative rates, and followed by QE in the euro area, together with forward guidance and the TLTROs, helped tremendously. But what you see is that if you're a bank that depends on deposit funding, you expand less. And that's sort of the story that also shows up in the papers. And in my reading, sorry, Gaston, my reading of Ulate's paper is slightly different. He actually mentions that negative rates are about 1/3 less effective than normal rate cuts, and this would square with that evidence. But I guess it all depends a little bit on the parameters. But the story seems to be that yes, negative rates were good. They stimulate the economy. We have loan demand. We have loan loss provisions. But it creates heterogeneity within banks. And some banks, the ones with high deposits, they seem to suffer, and they do things in reaction. They lend less. And another thing that seems to be in the data is that they take risk. So again, no econometrics. What you can do is you can just plot the average riskiness of the borrower. So you take a bank, you're looking at its borrowers, you say, okay, how risky they are. You look at, for example, return on assets variation. This is not high-end stuff, but what you see is that the high deposit banks, they're the ones that we usually think of being safer. And yes, their risk is lower, but this changes after you set the negative rates. So the high deposit banks, they seem to be now lending to riskier borrowers. Why would they do that? Because they can charge higher loan rates and help make up for the loss of revenue, for the increased cost of funding by not being able to set lower negative deposit rates. And this shows up also in their asset portfolio. So if you want to look, then that's in this paper. Sorry, I have jumped across. Now let me finish off with one thing, is that actually this was euro area aggregate. There is actually tremendous heterogeneity within the euro area that make things complicated for policymakers and interesting for researchers. So this was the time when we set negative rates. Now what you see is that the deposit rates are quite different across the euro area. They're very high in Portugal. They're very high in Portugal, and they're very low in Germany. So the banks could pass on maybe some of the lower rates depending on where they were located. If the bank is located in Portugal, it can pass it on more than if the bank is located in Germany. And so actually I'm exploiting this with a team of co-authors that uses this confidential credit register data from different central banks to look into this. And you clearly see that the funky thing starts to happen when the rates are already low and cannot come down much on the deposit side. Why do you see this differential deposit rates? And I'm going to finish with that. So here, what we're just plotting deposit rates and 5-year government bond rates. And of course, the scales have been adjusted so that there's this nice overlay, but the humps seem to everywhere line up pretty nicely. There seems to be a link between the deposit rates and the government bond rates. And there's also some research by Arvind Krishnamurthy and Anna Dissing-Jørgensen that points to the substitutability of these various safe liquid assets. Okay, let me finish with this because it came up in the presentation by Gaston as well. There's of course other channels. So you could think of looking at excess reserves that a bank holds, because those now carry the negative rate. If you bring those excess reserves to the ECB, they're remunerated at the deposit facility rate. But there's nothing special at zero for this, because the reserves are always costly, because you borrow them at a high rate and you deposit them at a low rate. So the spread matters. There's nothing that changes dramatically when the deposit facility rate goes to negative, when at the same time the MRO rate goes down. So it's really, you have to think about the spread, I think. Then there's some papers that exploit the short-term liquid assets, because the argument is that the rate on the short-term rates go down following the negative rate, but long-term rates come down as well, actually even more so. That's the funny thing, actually. In the breaking through the zero lower bound on the deposit on the policy rate told the market more cuts are possible. And what you saw was a tremendous movement at the long-term end of the yield curve. And so maybe, and this hasn't been exploited much, is maybe you'd see also differences across banks holding different government bonds, because the yield on the government bond reacted quite a lot. Okay, so that was it for me. These were the papers that I have drawn on. So there is quite a bit of research. And the message is that negative rates were good, but they could potentially pose some issues in the banking system for those high deposit banks. But we haven't really seen anything crazy going on, because the risk taking that you've seen seems to be good. It's not like you're lending suddenly to really worthless firms. It's just that the firms are riskier, but they invest and they employ more people if they get the funding from the banks. So thanks very much.
Thank you very much. So before I open the floor for questions, please, Jesper, you have the floor.
Thanks a lot. I have the advantage that I don't have to say that these are not the views of my institution, because I'm the head of the institution. In general, I mean, Denmark is interesting here because we were also seen in some of the other slides a front runner on negative rates. Denmark is different from some of the other countries in the sense also that we use monetary policy to steer our exchange rate, not to influence directly inflation or economic growth. We are an exchange rate targeting the euro. I personally, when this issue popped up, had thought that we would hit the zero lower bound as a less negative level than we apparently have had, and we haven't hit it yet. I did some calculations and I was wrong, but I guess I'm not the first economist who couldn't figure that one out. In terms of some of the earlier comments made, I agree very much with Jakob that the impact on the broader financial sector is important. We also have a very large pension and life sector in terms of 2 times GDP. I think we are second only to Norway in terms of the oil fund. And I also agree with Florian that the key thing is the shift in market and central bank rates versus deposit rates. That is a core issue, and it's an issue which raises questions on the sustainability of the banking model, which I will also try to address. More generally, I hold the view that the low and negative rates has put more fire under financial markets than under the economy. And for those who have my age and recall Sir Humphrey from Yes Minister, Sir Humphrey would have said to the minister or to the central banks that these are very courageous policies, by which he meant that they were potentially dangerous or foolish. I think I see them as a corner solution, and I generally know that corner solutions are places where you very easily end up in economic models, but where one should be careful of ending up in practical policy making. But here my focus is more on banks in Denmark and the banking model more generally. This is the picture from Denmark in terms of market rates, in terms of policy rates of the central bank. What it shows is that we were very early in driving policy rates below zero. There was sort of a little bit up and down, and since then it has been there more permanently, and long-term government bond rates have eventually followed and are now in steady in negative territory in a low for long scenario. If we see what's happening in deposits, Denmark has also developed further, possibly for 2 reasons. One, that we've had negative rates for longer, but also that there are fewer legal and political limitations on going negative. You can see here the deposit rates towards different deposit holders, banks, public sector, other financial, non-financials, and households. And even for households, the average deposit rate is negative. But it has been a lagged it has been a lack in terms of going negative. But everything is now negative on average. If you look at the share of deposits with negative rates, you will see that corporates developed quicker than households, but that the total now in terms of negative deposits is about 50%. The way the household negative rates have developed is that banks have gradually reduced the level of your account holdings from where you start earning negative rates. Today, for most banks, the above the equivalent of slightly less than 15,000 euros, you earn negative rates. They started out with numbers that were a factor 10 of these, or if not higher. But now, above 100,000 euros, you generally earn negative rates, and it is impossible for all practical reasons to find a bank which doesn't charge negative rates if you go high in your deposits. So what has happened, and what happens when the individual bank announces a negative rate? Well, the individual bank, when they announce negative rates, they see a small outflow as suggested in the study by the central bank on the left-hand side. But in general, deposits have increased quite substantially, as you've also seen in the euro area over the years, despite the negative rates. And why is that? Well, when you look at it, even with negative rates, the margin to the money market rates, to the central bank deposit rates have probably never been better. In the sense that you get on your deposit accounts, in a worst instance, a few basis points below what you would get if you were to put it into the money market or anywhere else. So deposits are actually quite a good business proposition, and I keep saying that, even though my minister occasionally says something different to the general public, that they probably never got a better deal than they have these days, despite that it is negative. So in Denmark, we do not have any general legal impediments as we have in many other euro countries. There is clearly a lower bound due to the existence of cash. We don't know where that is. The Danish central bank thinks that we are nowhere near that bound yet. As I stated, thought that we passed what I initially calculated, but I was wrong. But that doesn't mean that there's not a dissatisfaction with negative deposit rates in the general public. And the minister has recently caused a storm when he flagged the banks for going lower on negative rates and going lower in terms of what you can hold as deposits. But he met a lot of resistance, and even from the central bank. I, as a civil servant, was slightly more cautious. It is unknown how low the rates can go, though. One of the things which is also a difference in Denmark, and which helps a little, is our mortgage loan system. We have covered bonds which finance 2/3 of all credit, not only household credits, but also corporate credits. And our mortgages are funded almost by pass-through funding instruments. So basically, for most Danes who have a house, negative rates have also been a positive experience in the sense that it has been reflected in mortgage rates, which even in some instances have gone negative. And that has had an enormous impact, and is the link to the financial stability in terms of developments on prices of apartments and family homes, also recently. Mortgage loans, as shown on the right-hand slide, is quite large compared to bank loans, and we are quite unique situation in that sense. And that helps a little bit in terms of the banks in this country, which typically own mortgage banks or affiliated with them, in that they have this huge funding pool at market rates, at negative market rates, compared to other European banks, which are struggling with funding themselves to deposits. But earnings are lower on mortgage lending than in other businesses, but it helps. If we look a little bit on core earnings in Danish banks and the impact, what you will see is that the gray curve, which shows core earnings have been going downward, and they've been going downward because of the red component, which is net interest income. So the developments in the interest rates, as suggested also by Florian's slides, is that banks have been making less money in these areas. They tried to compensate to net fees and compensation and commission income, but it hasn't been enough. And they've also tried to compensate through savings on investments in staff and administration, but earnings have declined. And that has had an impact on return on equity, in particular in 2020, when impairments on loans and advances rose because of COVID. So this has caused a pressure on core earnings. If I may then turn to sort of a model which is more a business school model, but which I think is very illustrative in terms of thinking about the business models of various kinds of businesses. And I'll start with traditional banking, and then I'll move to where I think the competition will come from in terms of various tech platforms, and particularly big tech. So this is a model which shows basically who are your customers, what are your customer relationships, what are your channels, what are your value propositions, your key activities, key resources, key partners, and how do you make money? And basically, the value proposition of traditional bank is that we service all your financial needs, and you are households and firms. And you have a cost structure which is heavy on infrastructure and physical presence, and your revenue streams are under pressure, interest margins and fees. So you're challenged in your core earnings. Basically, I tend to say that banks have three cylinders which run them. One is the interest margin, which is under pressure from the low interest environment. The other one, which tends to be very important, but not as visible in a lot of the literature, is the term spread. They sort of ride the 0 to 1 to 2 year term spread, which historically gave them at 1% to 2. But the yield curve these days tend to be, or at least was until recently, fairly flat. And three, the knowledge of customers means that they can sell them extra stuff and they can make credit assessments. The two first ones are under pressure from the negative low interest rate environment. The fees and commissions and the knowledge of customers are under pressure from big tech, as I'll show in my last chart. So what does big data do? What is their value proposition? They do not just serve your financial needs, they serve all of your needs. They're convenient, they speak to all customer segments, they have huge economics of scale, and when more data adds values in terms of network externalities. And their revenue streams are related to data. So basically, they avoid some of the problems which banks have. They know their customers probably better than banks. And I think that's one of the key issues we need to look into as we move ahead and looking at banks which are under pressure, not only from the financial conditions and negative rates, but also in these environments when they can't make money on these issues in terms of what traditionally was one of their core advantages, which was the knowledge of customers, where there are now new players who know a lot more about customers than the banks do. These were my words for now. Thanks a lot for being able to join this session. Thank you.
Thank you very much, Jesper. I have a couple of issues that I would like to bring in. First of all, low or negative interest rates affect interest margins of banks. But as Jesper also showed in his presentation, banks may compensate or try to compensate that by increasing their fees. So perhaps overall the profitability of banks is, at least so far, not that much under pressure. Of course, there may be a limit to the extent to which they can raise fees. So that's one issue that I especially would like to Gaston about to reflect upon. The second issue I think that is relevant is the competition that banks face. Research on trust in banks versus trust in fintech companies, we can see that I think there's a lot of distrust when it comes to fintech. So, and that's especially because the public is concerned about data handling, and they have much more trust in this respect in banks than in fintech. So perhaps, and this is for Jesper to address, perhaps so far the banks, may be in a good position to deal with the pressure they're under I don't know how long this may last. So this is something I would like you to reflect on. And then finally, a question for Florian. What are the implications for financial stability if banks' profitability is under threat for some time?
There seem to be positive sides to that risk-taking. We know that banks tend to ration borrowers. They're just very conservative. And it seems that pushing them to lend a little bit outside their comfort zone has not been bad yet. The same on the securities. They've been starting to invest into riskier securities, and this buying has lowered long-term yields for those securities, also lowering interest rates. So right now, I don't think that there have been massive global problems coming from that channel. I mean, there could be other things going on, that these negative rates and a lot of liquidity fuel general exuberance in certain key markets like house prices. And we have looked a little bit in the ECB, we've looked a little bit at the non-bank sector, but it's very difficult to do this in sort of an academic way and finding the right identification. And there, I think they're the big troubles. I mean, clearly you mentioned these pension funds. Everyone that has sort of a fixed payout with a flexible funding is in trouble right now. And there's risk taking. On the profitability, profits are a tricky animal because they're a slow moving accounting variable. So I'm not so sure how useful they are to really assess problems. I mean, we get profitability at most at the quarterly, and there's all kinds of things that you can do from an accounting measure to dress up your profits. So in the profits, we do not also tend to see massive issues. What sort of convinced me was a little bit looking at the market. Okay, we shouldn't trust the market either. You know, it has its own interests. But the evidence coming from the market clearly thinks that some banks are really not being able to make it if this continues for the next 5 or 6 years. And my last remark, even though this was not a question, I think what we're seeing here is we're seeing by revealed preference how valuable deposits are to banks. Because if they're not willing to lower the deposit rate and let's say risk the couple of % decrease that were mentioned by Jesper in Denmark, then there must be incredible value for them to hang on. And so that's a source of revenue that banks can still hold on, and maybe they will be able to scrape on for a little bit more time. So, there are side effects that need to be monitored, but I don't see really like sort of a big storm brewing at the horizon in the banking sector. I think the problems are elsewhere, as were mentioned by you, Jakob, and by Gaston, and also by Jesper. Thanks.
Okay, thank you.
On your question, Jakob, about fees, unfortunately, we haven't seen any studies that try to quantify the rate equivalent of the fees that banks have been imposing on retail deposits. But there are, its notion clearly is that in combination with the fees, these rates, these effective rates, so to speak, have been negative in many countries where negative interest rate policies were pursued. So I think that's an interesting issue to try to quantify if possible. And I think it's also interesting to come back to Florian's point about that all banks increased lending, right? In your chart, it's just that those that were more reliant on retail deposits, they increased lending by less, right? So if they had been really badly affected, then we would probably see a contraction in lending. But of course, there is the issue of heterogeneity across banks and banking systems, which we discuss in our paper and which I alluded briefly. One somewhat puzzling aspect is the finding by Ampudia and Van den Heuvel That's a very good paper, which we also discuss in our survey. They reiterate, they do find a negative impact on stock prices stemming from announcement of negative interest policies. And so the question is whether that reflects a proper assessment by the markets, and we have not yet seen the full long-term impact, or whether that's a misperception by the market reflected in the stock market. I think that's an open question. I would argue, however, that by now it's not that we are in the short run anymore, right? We have had these policies, at least in some cases, for 9 years or so. So we cannot say that these have very short-term effects. So we would expect by now to see some of the longer-term effects to have materialized. So in that sense, I'm somewhat more inclined to believe that the stock market reaction has an element, at least, of misperception of the overall impact on bank profitability. Thank you.
Right, Jesper?
Yes, thanks a lot. I really agree with Jakob in the sense that trust is a key issue in terms of who you give your money to, and that is something banks have to play in their battle with big tech. In fact, I think banks have no choice but to play being regulated. I mean, they are regulated, and they need to play it as an advantage in relation to their customers. It's a little bit like sort of when you look at US banks, it says FDIC insured or regulated by the Fed or something along those lines. I think the danger for banks is not that big tech will start taking deposits, although they do to some extent, or lend out money. I think the danger to banks is that they will put platforms on top of the banks and turn back into commodity producers who do not anymore own their customers, which is one of the key advantages they have right now. And that way, big tech will also avoid the regulation because the regulation is something which relates to taking deposits and not in terms of, or at least not to the same extent, in terms of guiding the money to wherever you can get attractive conditions on deposits or loans or whatever you want to do. And that also brings me to the fee issue. Clearly, banks will increase fees. Historically, they subsidized a lot of things like payments and other things because they made money from the interest rate spread. And that was sort of a captive business model. But the moment you start to charge for payments or other things, you start competing with others. And I'm not sure that banks are as efficient as some of these other players, in particular big data, in relation to performing in these areas. One of the things which is interesting is to see, and particularly in payment services, how other players have captured that industry. And I don't know whether you know it, but at least according to the Financial Times, I saw the other day that the highest capitalized market cap firm within the financial industry is Visa, something which 10, 20, 30 years ago would have been thought as the most boring business you could get into. But it's also suggested by these Irish brothers who established a new fintech payments thing. If you can charge 1% on all internet commerce in the world, you really have a pretty good business model. In terms of profits, I really agree that profits is not what you dive off or low profits from one day to the other, but it lowers your first line of defense. It makes you more vulnerable when you have an economic setback. And it's a little bit like slow strangling and a death, lack of oxygen. And there, I think, in terms of Europe, the problem which we really have to deal with is we need a resolution policy, a resolution framework where we do not rely on government support to keep zombies alive. because that's what we've been doing until now. We've implemented BRD, but BRD has not, the bank recovery and resolution framework has not been followed in spirit, and we need to do that in order to deal with these issues. Thank you.
Thank you very much. With that, I think time is up, so I'd like to hand back to Ernest.
Let me thank Gaston, Florian, Jesper, and Jakob for sharing your analysis and for being ready to answer our questions. And to all of you, we were altogether 175 participants today, for your interest and for your many questions and comments. Thank you very much. Bye-bye and take care.
Bye.
Bye-bye, and thanks.
Thank you very much.
Thank you.